Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas, and you want to know about adjustable rate mortgages? Well, stick around in this video. I'm going to teach you why adjustable rate mortgages are better for the interest rate and becoming much more popular with a lot of home buyers out there. Let's get into it. As we see the DFW housing market continuing to trend in the right direction, people still have a little bit of concern around interest rates. And I agree why they are lower than they were in the past. They're still not where we want them. They might be there in a year from now. But strategically, what a lot of folks are looking into and considering these days are adjustable rate mortgages. I know adjustable rate mortgages have a bad name. They have a bad name because of the subprime days when you had like a 2-year adjustable rate mortgage with a prepayment penalty on it. Those type of adjustable rate mortgages are not what I'm talking about. Those are dead and gone. They don't exist anymore. Some of the overhaul during Wall Street reform got rid of all that stuff. I'm grateful for that stuff. And so sometimes I think that people are scared to talk about adjustable rate mortgage, and that's what I want to talk about today. 2 reasons. One, when you're getting a home loan, one of the most important things you need to realize is that you need to tailor the home loan specific to the client's needs. Everyone's needs are different. Their age group, how long they're going to be in the house, what the financials look like elsewhere, do they have debt, do they have savings, all these things. But down to the meat and potatoes of the mortgage, you don't need to take a 30-year fixed. It's not gonna be a forever home, so you don't need a forever loan. Adjustable rate mortgages have become more popular over the past probably 24 to 36 months. Why? 2 things, structuring and interest rate. First and foremost, let's talk about structuring. Structuring means when you're buying a house, one of the questions I will ask clients is, hey, best case and worst case, how long do you see yourself in this home? I never ask them how long they're gonna see themselves in this loan, and I'll talk about that here in a minute and why. But most people, first-time home buyer, second-time home buyer, third-time home buyer, it keeps their property on average anywhere from probably 5 to 7 years, maybe 7 to 10, but no more than 10. And the reason I bring this up and I ask people is because if it's a starter home from somebody, they say, hey, we're gonna be here 2 or 3 years, we're gonna get our feet underneath this, and then we're gonna buy our second home. If it's our second home, hey, we're gonna be in here 4 to 5 years, 5 to 6, third person, maybe 7 to 10. And so all this helps me tailor everything specific to their needs. And adjustable rate mortgages come in a few different options. They come in a 30, they're all 30-year payment schedules. They're just not fixed for 30 years. So you can get the ARM to where it's fixed for 3 years, fixed for 5 years, fixed for 7 years, and fixed for 10. Me personally, I like the 7-year ARM. I have a 7-year ARM on my house. What that means is it's on a 30-year payment schedule, but it's not fixed for 30 years. It's only fixed for the first 7. It could adjust in year 8, up or down, which we'll talk about here in a minute. But I like the 7-year ARM because I think that 7 years is enough protection around an adjustable rate mortgage to where if you have any hiccups in the markets and things go to slump and you were in a tighter and a shorter timeline and the adjustable rate mortgage was to go up or had you refinanced to get out of it to get into a permanent loan, I think anything less than 7 years is probably not a smart idea. Now, that all being said, I do keep the 3 and the 5-year option available. Those products are usually designed for people that are relocating to Dallas and they're only gonna be here for 2, 3, 4, 5 years. Like I've done this for 2 doctors that are on like 2 or 3 contracts here and then they're going back to North Carolina. There's no reason for them to take a 30-year fixed. I always say, hey, whatever you think you're gonna be here for, tack on to 2 years, and then that's a safe adjustable rate mortgage and structure for that person. So, hey, I'm here working on a 3-year contract with ABC Hospital. Okay, great. I think we should do a 5-year ARM. I'm here for 5 years. It's a 7-year ARM. Now, when it comes to your traditional buyer, again, most people, I put them in this world so they'll understand that like adjustable rate mortgages are good. They're only not good for 2 reasons. 1, if one's trying to be forced on you without explanation of the pros and the cons. Or 2, you get in one and you let it adjust up after the fact and don't do anything about it. Those 2 things never happen with me, and let me tell you why. First and foremost, on an adjustable rate mortgage, the improvement of the interest rate from a 30-year fixed is about 1/8 to 1/4 lower for each ARM increment that you choose. And the shorter the incremental period, the better the rate. So here's an example, okay? 30-year fixed mortgage, $699. If you want to get into an ARM, you can get a 10-year ARM, okay, which is the highest ARM, fixed for 10 years, obviously on a 30-year note, but instead of being $699, it'd probably be $675. Then you could go to a 7-year ARM. A 7-year ARM, $699 would probably be 6.625, maybe 6.5. A 5-year ARM, maybe 6.3, 6.2, and then a 5-year ARM, maybe 6.1. So there's anywhere from probably 0.5% to 0.75% pickup on the interest rate for the client from a 30-year fix to an ARM. Now again, I don't think the 30-year fix is something everyone has to take. You can get all the benefits of a cheaper interest rate and keep the risk way down when it comes to selecting an ARM. Because truth be told, most people are not going to stay in their house for more than 10 years. But even if some people end up staying in their house longer than they think, that doesn't mean that the adjustable rate mortgage they're going to be in is the loan they're going to be in for the entire time that they're in the house. So let's say again, hypothetically today, interest rates, we're making this up, are 6.99. You decide to take a 7-year ARM, 6.625. You basically get 3/8 off the rate. It saves you a great amount of money. The loan is tailored specific to your needs, but in that 7-year period, remember, there are no restrictions. You can refinance in this thing quickly. So let's say, hey, interest rates get better in a year. They drop to 5.99. And you want to refinance out of that ARM into a fixed or into another ARM at 5.99 or 5.5, you can do that. There are no prepayment penalties. There are no restrictions. It just gives people more interest rate relief around their monthly payments and around their notes, tailored specific to how long the client believes that they're going to be in that loan, in that house. A good example would be, why would you put your money in a 5-year CD if you needed it back in 2 years? Why would you get yourself a 30-year fixed and a forever loan if you're not going to be in a forever home? I think the most important piece about ARMs is explaining to everybody what they are set up to do, how they can go bad, but also how they benefit the consumer. They are set up for people that are only going to be in that loan or in that home for a shorter period of time, and they want to give the consumer a cheaper interest rate because the investor loaning that money, when they loan the money out in a 30-year fixed, it's possible that person can sit on the net for 30 years and they may not get their money back for 360 payments. Doubtful. Most people obviously keep their place for 30 years, but this is the thought behind it. Versus when you get into a 7-year adjustable rate mortgage on year 8, the likelihood of that investor getting that money back at year 7 or even prior to, because the consumer wants to either sell or refinance the note, is much better. So what happens is they give them a better deal. By giving them a better deal, they are encouraging them to say, hey, take this lower interest rate, make your payments cheaper. Now, they do the same things in the 10-year and the 5 and the 3 as I did in the illustration, but I just don't like those. I especially don't like the 5 and the 3. It's too close for comfort. Interest rates can adjust on adjustable rate mortgages after the fixed period is up. Now remember, they can adjust, but they can also adjust down, not just up. And I think people have that misnomer about it, which is like, oh, well, if my interest rate is 6.25 at year 8, it's going to go up. Not necessarily. It is an adjustable rate. So if the market is better, it can adjust down. If the market is worse, it can adjust up. If the market is the same, it'll stay neutral. And it doesn't go from like 5.99 to 8.99 overnight. There are stair steps of protection to make sure that the consumer is not caught off guard, because really, guys, understand that banks want loans to perform. This is how they make money, is on the interest. So if they pushed your interest rate all of a sudden from 5.99 to 8.99 and somebody's payment went up by 35%, that would give them payment shock. That could potentially put them in a position where they might default on the mortgage, and the bank doesn't want that. So all that being said, adjustable rate mortgages are great products for people that are not going to be in a forever house or probably not going to be in a forever loan. You get anywhere, like we discussed, 0.5% to 75 bips off the rate. You can improve your position by considering one of these. But I think knowing the pros and the cons of it and having somebody who is a mortgage advisor walking you through these things will set you up for much more success in the future. And so now we're starting to see the adjustable rate mortgages becoming more and more popular as people are starting to learn and get more education around them, about them, realizing they're not that risky. I don't think I'm gonna be in the house and or the mortgage for that long, but if I am, I have a good runway. If I choose a 7-year ARM, I can refinance at any point in time if I need to get out of it or rates get better. And so you really get all of the reward with very low risk, and that's why I believe adjustable rate mortgages are gonna continue to become a more popular product for the remainder of 2026 and probably even heading into 2027. So listen, I hope you found this video useful. If you did, do me a favor, like, comment, subscribe. If you got any questions about pre-approvals, adjustable rate mortgages, or just want to discuss details around maybe buying, selling, or refinancing a house in Dallas, Texas, do us a favor. Call us, email us, text us. We're always here for you. Until next time, stay tuned.